to join us as well. Okay, cool. Thank you everyone for showing up at 9 a.m. and so many people showing up. Ronit, you feel the pressure? So today we are here with Ronit Ghose, who I will let introduce himself. Before that, let me introduce myself. My name is Raja Skogland. I'm the CEO at TheFactory Academy, where we currently run 3 accelerator programs. So I'm going to be admitting people at the same time, so please don't mind, I will be a bit interrupted. So we run 3 accelerator programs right now for startups. We have Gründer Academy that is open to any type of startup. We don't look to the industry in particular, we're just there to help them. So if there are some entrepreneurs listening to us and interested in being accelerated, getting access to the fundamentals and getting access to what will help them build the right foundation to grow and scale their business, please get in touch with me later. And we also have 2 other accelerators that this time target specifically FinTech, PropTech, and retail. With the first accelerator targeting everyone and open to everyone, we have over 100. I think we even have over 120 startups registered from New York, from Asia, from the Nordics, from Europe. It's quite some very good startups and quite impressive reach that we managed to get. And for the startups at the Startup and Scale-Up Academy, where we have FinTech, PropTech, and retail companies, we have over 30 companies that we're helping right now get access to mentors, advisors, knowledge tools, the right partners, and as well investors. So that's for myself and the factory. I have some guidelines for all of us to make sure that this session goes smoothly. So please, I'm still accepting people. We have Tobias from Soprasteria who joined us. So please mute yourself so we can ensure a good sound quality. And this session is recorded, so it can be available to others as well. Yes, I think, can everybody hear me? Yes, right? Perfect. I think that's it for the guidelines. Oh yeah, an important thing. Please use the chat. This is an opportunity to ask your questions to an expert, top expert in the world in FinTech. Yes, so please take this opportunity. I know that we also have some people from academia that are recognized, and I will go to you to make sure that you also get your questions answered. Please use the chat. If you have questions, either you post them in the chat or you just say, yes, we have a question, I have a question, and we will make sure at the end we will leave maybe 20 or 30 minutes, depending on how many questions we have. We will leave this enough time for me to go to each one of the questions and ask you to actually ask the question directly to Ronit. Okay, we still have some people joining. That's awesome. I think I'm just going to let you introduce yourself, Ronit, and thank you for joining us.
Great, thank you. Thank you for inviting me to speak to you guys today. My name is Ronit. I am an analyst at Citigroup. I've been with Citigroup far too long now. I joined in 1997, a predecessor firm, or became Citi the year after. And my career at Citi has taken me to countries all over the world. For much of the time, I was based in London. I first visited Scandinavia in 1998, so I've been visiting for over 20 years. So I'm reasonably familiar with the 4 different Nordic markets, and even some of the Baltic markets. So I haven't been for a few months because I'm stuck now because of COVID. In 2016, I moved out to Dubai, and since then I've been based here in Dubai. I have a couple of different roles within research. I run our global banks research team, and also with the help of a colleague in the US, our FinTech research team. So I write about, talk about, publish, speak about everything to do with financial services, both modern and traditional, FinTech and legacy. I also provide advice to investors, clients, corporates, and outside Citi, I help a few friends who run emerging FinTech companies. And I'm sure during the next 55 minutes, we can explore some of this in more detail.
Yes, thank you. And I think we're just going to go straight to what we wanted to discuss today about how COVID-19 has impacted the fintech industry and banking. And maybe let's start with you. How did it impact your job on a personal level?
Absolutely. As I just said, I moved out to Dubai in 2016. And part of the reason I moved to Dubai is it was a great hub to focus on the world, particularly in what we call emerging markets, Asia, Africa, and of course the Middle East, the home market here. And I chose Dubai for many reasons, but one reason was that it was a great hub that I could fly everywhere around the world direct. I could fly to Scandinavia, I could fly to the US, Europe, Asia, Africa. And so every second week I would be on a plane. I would go through Dubai airport. I was joking with my wife a couple of months ago that I don't think she's seen as much of me as she has in the last 4 months, from probably the mid-2000s. So my life changed dramatically, as did a lot of people who work in financial services. We went from basically being in offices and airport lounges to doing this, traveling virtually. And in many ways, I was already remote because the center of big companies tends to be big cities like London or New York or Hong Kong. So being in not one of those major hubs, I was already interacting with my colleagues globally. So I was already somewhat remote. But this has made it a really interesting transition for all of us. Whether we work in companies that operate in one country or one city, or in our case, over 100 different countries, it's completely changed the way we work. I think in big banks like ours, 85, 90% of employees have been working remotely for many months. And generally, it's gone quite smoothly. So obviously, it's changed our day-to-day lives. It's also changed the requirements on technology, the requirements on how we think about working from a social and psychological perspective. But simple things like the technology with everyone basically. We have over 200,000 employees. So can you imagine 80, 90% of those people working remotely, logging onto the systems remotely? That creates great capacity issues, strains, pressures. And banks all around the world are coping with this. I was talking to a friend of mine who works in a big local bank here in the UAE, and it's been exactly the same challenge for them. How do you go from talking about having a digital company or having a digital company is actually living it? And for many banks, the gap between talking and living, as the Americans say, talking the talk and walking the walk, happened in the last 3 months. We realized that, yes, we can do our jobs remotely, but we still have work to do in terms of the technology side, the cultural side, the social side. It's been a fascinating change. Big banks have generally been a good place to adapt. They have the advantage of scale. They have the advantage of quite deep financial resources. It's harder if you're in a small early stage startup, particularly a B2C. I'm sure we'll talk about this during this conversation. Many of the B2C startups and even some of the more established B2C challenger, like in the UK, the neobanks, have faced an interesting and difficult period.
So what would be, how did you see that concretely? So I hear that for you, this period has actually, it brought transformation and acceleration, right?
Very much so.
So concretely, how did Citi tackle that challenge? What happened? What were the operations? Did you like all of a sudden bring people together and created a think tank of what are the best practices now moving forward? What was your approach? We have some corporates listening, so that would be interesting for them.
One of the advantages of being a global company operating in many markets is that when COVID began to hit Europe and the Middle East in March, our Asian colleagues, our colleagues in Asia, in Hong Kong, in Shanghai, and Singapore, they'd already had experience of dealing with this. So, when you look at sort of back to January, we were very much talking about COVID all of us in the world, in the media, in public and private conversations, we were thinking about COVID as an Asian or a Chinese issue. But obviously, what happened 2, 3 months later that we realized it was a global issue. But big global companies had this advantage. We could copy best practice. We could see what the Hong Kong office had done in January or February. And then we could copy that over to London or Oslo or Stockholm or Dubai in March and April. So we were generally very fast at, and I think this is not just about my bank, but generally banks, big banks. We were very fast at shutting down international travel, well, often well before governments mandated it, encouraging people to work from home. I know in the London office, there was a lot of encouragement for people to work from home. And some of my colleagues from February were working from home. By March, late March, it was universal. But and also in our roles, there are some functions. Obviously, if you're in a frontline consumer branch or if you're on the trading floor, there are a small number of functions where you have to, there's a benefit, or you have to be physically present to execute, to do your job. But in many jobs in financial services that are advisory, you're giving advice, you're providing analysis or information, you can do that remotely. So the nature of our jobs made it easier to transition to remote working. But remote working has been, it's been discussed for many years. But there was always some, in some people's minds, there was a certain stigma to it. You have to be in the office. You have to be in the head office or the main office or the regional head office. And it's been, I think, interesting for many senior managers. They can see their companies. And this is not a Citi-specific comment. This is when I talk to the banks that I analyze, the big banks, many of the senior managers, maybe from a different generation, maybe slightly older, might have had some reservations about remote working, but they can see that their employees actually are very productive. In fact, the risk sometimes is they work too hard. So one thing our senior management in New York is encouraging is to take Fridays off now and then, because everyone's working, literally sometimes 24/7. So I think there's been a real mind shift, mentality shift. You can trust your employees to actually deliver, even if you can't see them.
I remember when we started this home office, and my husband is also in the finance industry. I told him, this is not home office, this is non-stop office. And now he goes, he can go back to work, and he goes to work a few days per week, but he wants to go on Friday. So he feels like the weekend is starting,
Yeah. That's a big challenge. No, it's absolutely. I have colleagues in many countries around the world who are very keen to go back to the office for that reason, because they want to have a break when they leave the office. Yeah.
I would really like, we have 51 people with us. Please use the chat if you have questions. I will invite you to jump into the conversation. So please do it, and let's not wait till the end. In 20 minutes we can start taking your questions. Okay. So we have a few startups. We have many startups listening to us. What have you seen in the market right now? What are the fintechs that are struggling? Those that are actually doing well? But I would say, what should fintechs focus on, and entrepreneurs who are interested in starting a business now in the fintech industry? What are the problems worth solving right now, or that you see? This is becoming a long question. Please remember.
So how many sub-questions there are in this question.
So if this is the new normal, what should they look at? The advice to entrepreneurs. Sure.
So one way to answer the question is to follow the money, is to look at where funding trends have been going. And we'll come back to products and services in a second, but following the investment dollars is a good way to sort of deal with this question. For much of the last 3-4 years, there's been a huge boom in financing and availability of finance of fintechs. When I speak to some of the founders of fintechs or challenger banks, who I know very well, particularly in London and Stockholm, when they started out, often in 2012, 2013, 2014, funding was really difficult. Getting money was very difficult. Fast forward to 2019, and the environment had changed. Almost the cost of capital for fintechs, the availability and cost of finance had dramatically improved. So much so that I used to joke last year that actually banks managements have a disadvantage versus fintechs. It's more expensive for banks to fund themselves in terms of raising equity, because in the equity market, investors will say, I'm going to put this multiple on the bank's earnings, maybe 10 times earnings or 12 times earnings. And yet here you have, as of last year, these fintechs raising money at 10 times revenues or 15 times revenues, very different multiples. Now, that kind of very bountiful, very sort of open environment for fintech changed in Q1 this year. And you saw that change particularly in Asia, not so much in Europe, but you'll see that in Europe in Q2, in the Q2 numbers. So when you look at fintech funding, Q1 of this year is the worst quarter since Q4 2017 for dollars raised. And specifically in Asia, or China is basically the big part of Asian fintech by dollars. In China, it was the worst quarter Q1 since 2015. So you saw a significant, almost a drought, almost a capital drought starting in Asia, big declines in capital availability. And the same is happening in the rest of the world now in Q2. And where you're seeing the biggest slowdown is, no surprise, is in the B2C space. Where you're seeing more resilience is in the B2B space. It's also an emerging consensus now that B2B right now is the place to be. Why B2B versus B2C? Because B2C was very fashionable pre-COVID, because everyone was talking about, oh, these banks are old-fashioned, da-da-da-dee, we're going to have a better, whether it's a neobank or better FX solution that you can travel and get FX for free or low cost, or better client experience, better client service, so there was a lot of interest in B2C. And what happened as we went into the COVID is a lot of these B2C models are based on activity in the real world. I need to use my card. I need to use my card when I'm traveling abroad. Otherwise, the fintech's not making any money, because the revenue model of many of these B2C fintechs is based on interchange. Each time I swipe my card, the fintech makes money. Those revenue models are obviously under pressure because people are not traveling. Anything based on interchange is going to have a very difficult first half of the year. But that's no surprise. But B2B is, what I said about how, we went from very few people working remotely to 80-90% of the staff working remotely, or maybe even higher. And this is true across all big banks. So all big banks and even local regional banks are thinking, how do I improve my digital resilience? Whether it's in terms of communicating with clients, whether it's in terms of people working inside the bank. As a result, B2B solutions, when you're selling something to a bank, whether it's compliance, rec tech, communication with their clients, all the B2B side has been much more resilient. Now that's just now. In 2021, it could be completely different. So if you're a B2C fintech and you're listening to this, don't despair. I'm not saying B2C is dead. I'm simply saying that B2C was the fashion spot. And already, if you were looking at the US and Europe last year, B2B funding had picked up. B2B funding was growing faster than B2C. In Asia, China, emerging markets, it was still very, very B2C driven last year. So what's happening this year is that the existing trend of interest in B2B is being further accelerated. So in many ways, COVID is just an accelerator. It's just speeding up things that were happening already. But there's some really interesting series breaks where it's not just acceleration. There's a completely new thing happening. And of course, many of our listeners today will be aware of the origin story of Alibaba and Alipay, and the original big daddy of B2C e-commerce, and then the world's largest fintech that came out of Alibaba. That started in 2003. Now, it might be a coincidence, it might be causation, but 2003 is when China was being hit by SARS. And that's exactly when B2C e-commerce started in China. And the year after, in 2004, Alibaba set up what was their payments department, which then became the world's largest fintech. So as well as acceleration. I think if SARS is a case study, historical precedent, you're going to see COVID give us some real series breaks as well, which would be super interesting to watch.
Thank you so much. So now, actually, because I know some people in the audience, and I want to invite them to ask questions. Okay, so we have Kevin. Kevin, please unmute yourself and ask your question directly. And put your camera on.
Hello.
Hi, Kevin.
Hey, good morning, and good to see you, Ronit. Long time no speak. I was just wondering about the stats on those figures that you mentioned, because I have been reading up on stuff like Spotify as well raised serious funding in downturns turns earlier, and I have been in, how should I say, heated chats about fundraising in in distressful periods, because turbulence and movement actually creates opportunity. So I'm in your side of the field in a way that it does create opportunity for the right types of companies.
Kevin, excuse me 1 second. Can you, because not everybody knows you, can you please just tell us briefly what your company does?
Oh, yeah, sorry. My name is Kevin Greater. I'm the founder, CEO of Monitor, and we automate financial decisions, in particular around timing of the currency markets. We're a B2B company that basically tracks and helps with decision making around entering the market in FX.
Thank you.
If that makes any sense.
And what was your question?
Well, basically, if you guys have any stats on what you just spoke about, because I'm of the same ilk, having looked at other companies in Europe as well, having fundraised in turbulent times or nearly downturn times, and sort of how can we take advantage of the funding situation as we're in a B2B scenario. I think if you come out of this phase in a year's time in a stronger position, then you're better rigged to. So we're actually pressing hard now in order to come out this tunnel, if you will, on the other side. And I'm just looking to back up that with some of the stats that you potentially mentioned there.
Sure. In terms of the exact numbers, we can share that maybe via Annalie or Raha. We can share that later on. I don't have all the specific dollar numbers in my head, but the big picture trends for Q1, which is the last data point I have, is that the US was down year on year in Q in terms of funding. Asia was down a lot. Like I said, it was the worst quarter since 2015 for Chinese FinTech funding. But Europe was up in Q1, and Europe was, if you went back 2 or 3 years ago, Europe was generally quite a laggard when it came to FinTech funding. Now, there are some exceptions, like per capita relative to GDP, Stockholm was always a positive outlier inside Europe, but Europe's really picked up in the last couple of years, and that momentum carried on into Q1. The concern would be is that when we see the Q2 data, or we can see already anecdotally in terms of funding being raised in the UK or elsewhere, some particularly B2C firms are raising funding at significant discounts or lower valuations to previous rounds, right? I mean, I don't need to spell it out on this call. Firms. At the same time, there are others that are raising funding at very good multiples. And again, I think we've seen one just in the last week in Stockholm, in the last week or so. And so, what was interesting about the trends so far this year is there will be, particularly in early stage VC, but generally a slowdown in capital availability, because people want to wait and see where we come out in terms of what the new run rates are. But corporates, strategic investors, such as the PayPals of the world, the big card companies, also the big techs from the US and China, the Amazons of the world, they're still going full steam ahead on their investments. So what you've seen in the year to date, but particularly the Q1 data, is M&A into FinTech has actually been really strong, corporate M&A, because, and you can see this in the stock market, right? These large companies I mentioned, the Amazons, the Alibabas of the world, they have huge financial firepower. I mean, the market value of these companies, the multiples they trade at, hasn't really been hurt year to date. There's been a V, right? They went down in March and they've come straight back up again in many of the cases in the US. So those partners, either as investors or as minority investors or complete strategic buyers, they're still very, very active. On the specific numbers around VC funding, I mean, the source I use is TechCrunch, so that's publicly available. We can share the data we have as well after this call with you guys.
That would be great. Thank you.
Thanks, Kevin.
Thank you. We have a question from Stuart. Stuart, would you like to jump into the conversation and ask your question? Or I'm gonna just read it. Hi, Ronit. Which segment areas do you think will receive funding during post-COVID? In increasing order, that is most preferred to least preferred.
I would sort of repeat or go back to what I've said before. For the foreseeable future, if you're providing a solution, a B2B solution, to the financial services industry, either front end, client facing, on communication or on analytics, or on the risk side, there's certain things a big bank has to do to stay in business, to operate. You have to be compliant. You have to meet your regulatory requirements. You have to look at risk, and if you can provide tools to do that better, or cheaper, or faster, and preferably all three, you're going to have a home run. So some of the fintechs that I know that have done very well in the last couple of years are very much in that space. Innovation. This is an old saying, right? Innovation's either do it faster, cheaper, or do it different. It's like basically having the faster horse or having the automobile rather than the horse, right? So if you can come along and say to a JP Morgan or a Citi, let's take JP Morgan, so I'm not talking about my own company. JP Morgan have, it's public, about 40,000 people in legal, compliance, risk. Actually, not even risk, in legal and compliance. In legal and compliance, they have 40,000 people. And this was from an annual report, like maybe even 2 years ago. Now, can you imagine if you came along and said to them, and our numbers are not that much different, they're slightly lower. It's again a public number. You came along and said to them, look, I can do that function differently or better or cheaper. They're going to listen to you. You're going to have so that's a big opportunity. The other one is providing something. The other big home run for me is the big techs are the big disruptor in all industries, including financial services. Whether it's in China, in the future, of course, there's a role for fintechs in B2C. I'm not saying independent fintechs can't make a name for themselves, have a really viable business. But in terms of overall in the market, the big techs are they're the big disruptors, the Amazons, the Alibabas. If you have a product that's existential, think about what's an existential threat to a PayPal or a card operator, and you have a product that helps them hedge that, you are going to get a silly multiple. Not silly, funny, silly, like crazy, high multiple, because they're not going to pay you on your current earnings, your current revenues. They're going to pay you on basically you're providing them with a hedge against non-existence. And their market caps are 100 billion, 200 billion, 300 billion, depending on which one you're picking, of the card operators or PayPal. They're going to be willing to pay you a very large multiple on your current revenues. So those are the areas that for me are most interesting. But it's like, I mean, oftentimes it's also not just cool tech, but just a price point. Some of the most successful B2C fintechs in the UK and the US have been, you're just doing something at a different price point. Look at Goldman Sachs and Marcus. They've had to shut their UK neobank to new deposits in the instant access category. Why? Because they were operating at a different price point, at a higher price point, and they were getting so much money coming in. Their tech is okay. I mean, it's good enough. It's not revolutionary tech that's underneath Goldman Sachs and Marcus, but because they were a digital bank built from scratch, they could operate at a different price point, and that just brought in so much new funding. So yeah, the ability to operate at a different price point is also crucial in B2C.
This actually makes me think of a question I wanted to ask you. Who are the future, or who do you see as future competitors to the banks? You mentioned big tech. So what's the future of banking actually? Are banks still going to do the traditional work that we expect them to do, or are they going, since you are in the research space, what do you see that maybe banks are going to start helping clients with that they're not doing currently?
Sure. So banking as a function is inherent to modern society, and it's been around in one way or the other. You can trace banking for 5,000 years, but how a bank looked in those 5,000 years changed dramatically. The institutions that we live with, whether it's in the UK, US, or Scandinavia, were largely created in the last 200 years. And you can go back to the founding dates. Like you can go to see, when was JP Morgan built, or when was it? The founding dates of most of these big banks in the US, in the UK, in Scandinavia, they go back to the sort of the Industrial Revolution. So urbanization, industrial change. So each time there's a big series break in society or economy, the nature of banks changes. Before that, if you go pre-industrialization, banks used to basically exist to deal with super rich people, like kings and queens. They wanted to build a palace, they wanted to fight a war, and then merchants, in Renaissance Italy would fund you, or in early modern Frankfurt, or in early modern London, they would fund you. Then as you got the Industrial Revolution and urbanization, all the modern banks that we live with, I mean, everything is, you walk down the proverbial UK high street or now digitally online, those big banks were set up typically between 150 and 200 years ago. And in the last 20 years, we're having another major series break, particularly in what's called emerging markets, in China, in India, and Africa, which is these societies are coming into the modern economy in a way that for the US, Europe, UK happened in the 1950s, 1960s. So whenever you have these big series breaks, banking changes. And that's why banking and the big transformative change in the last 10, 20 years is the role of big tech companies. So that's why I mentioned Alibaba and Amazon consistently in this conversation. They are economically, financially, culturally, socially, they're the dominant companies of this generation, of this age, of the last 10, 15 years in the US and China. So they will be a major, major player in financial services, particularly on the consumer end and the SME end. Capital markets is slightly different. Large capital, large cross-border transactions, wholesale banking, capital markets, that might still remain the preserve of large specialist financial institutions. You could say effectively B2B financial services belongs to some of these global banks, but B2C, no one wakes up in the morning saying, I've got to get a mortgage. They wake up in the morning going, my family is growing, I want a bigger house, right? Or my family is shrinking because my kids have left home, or I've got married or I've got divorced. So people go and get a financial product to do something else. I'm buying a car, or even going on holiday. And so the financial services product gets embedded in another transaction. And platform companies, be they big tech or other platform companies, can embed financial services in the day-to-day transaction. So there might still be there'll still be a regulated bank. Question is, will it be one of the existing banks, or will it be a subsidiary, a fully owned subsidiary of one of these big tech companies? Now, we believe, or in research, this is a research view, this is not a Citi company view. I should have probably said right at the start of this conversation, as everything I'm saying is a view of Citi research rather than big bank entity. So the Citi research view is that most big tech platforms in Western Europe and the US will not want to 100% own a bank subsidiary. So they'll partner. They want to own the client interface. So effectively, you could have balance sheet as a service or banking as a service, where large existing regulated institutions will go, I'm really good at financial risk management, at balance sheet management, maybe cross-border payments. I will provide those those points of expertise to you, and you, big tech, will be the client interface. So that's one likely model in my view, in particular in B2C.
I had a chat with I'm not going to mention the name, another bank a few months ago before COVID, and their research center was actually looking into what, since bank represent trust. That's the fundamental. We trust an institution. That's why we put our money, our gold.
Yeah.
So, and we have big techs, Facebook, Amazon, Alipay coming to disrupt that space.
Yeah.
So this bank was looking into what is now a value, an asset for people to put in the bank that is not money or gold or whatever.
Yeah.
So we're looking into data and people's data, family data, pictures, as simple as that. So is this something that Citi is also looking into, or is it something that now, since we are going through this very challenging time, banks should not look into going into helping people collect their passwords and the pictures? And what do you think?
Yeah. So absolutely, big picture, trust is inherent to banking, and sometimes, if you're a new entrant or a challenger, you look at the banks and go, why do these banks move so slowly? Or why are they not more innovative or taking more risk? And part of it is that there's this tension inside the bank. From, I said, 5,000 years of history, it starts with, you can go back to recorded history in the Babylonian times. People come to the temple and deposit. Here's my valuables, look after it for me. So this idea of custody and safekeeping is core to financial institutions, and there's this very long history of that, of safekeeping and custody. And then in modern times, there's a layer on top of that, which is regulation. If I give £85,000 or €100,000 to my bank, and it's a regulated institution, I know that I'm getting the money back. Most people don't have more than €100,000 in the bank. And so I know all my money in the bank is literally safe because it's backed by the state. The state has to fail. And because of that backing you get from regulation, from deposit insurance, that comes with all kinds of regulation, which the banks have to implement, which if you're a tech company or a FinTech, you may not want to have. So as a result, because of history and regulation, societies generally trust banks. Now, there are some exceptions. Like if you go to the Horn of Africa, if you go to like Somaliland, there's no functioning state. So people don't trust banks. What they do is they actually use their mobile company. Mobile money is how telcos become the bank, this almost central bank in those countries. But in most countries, in like 98% or some very high number, people trust their bank, and that trust factor is huge, and it's for all banks. This is a major asset, but it's also a risk. You can't abuse that. One of the reasons banks are sometimes cautious about using that data to cross-sell is, compared to say some of the big techs, is exactly that point. Is you don't want to be seen as abusing that data. So it is an asset. It's an advantage. And in some countries, so in Scandinavia, the bank ID is in many ways a portal into. It's like giving your ID, right? It's banks are basically almost keepers of digital identity. Same in Nigeria. In Nigeria, there isn't a national identity scheme that's comprehensive. Last time I checked, it might have changed the last 9 months, but last time I checked, that the most comprehensive database there is of individual ID in Nigeria is bank ID. There are 40 million people with a unique bank ID. And so you can, that becomes your identifier. Now, if you're in India today, compared to India 20 years ago, there's a national ID scheme, which is biometrically, very advanced. And so you can use that national ID scheme. But in many countries, the bank can become your identity guarantor. And there's definitely a role for that. But monetizing it, it's almost inherent to the existing franchise. I don't know how far people want to monetize that or try to use that as a new revenue stream.
Thank you. We have a question from Ahmad. Can you unmute yourself, introduce yourself,
Yes.
and ask a question? Thank you.
Yeah, hello. So my name is, can you hear me?
Yeah.
Yeah, so my name is Ahmed Emil Lotfi, and I'm a PhD candidate at the Norwegian University of Science and Technology. And actually, my research is within the field of FinTech. So I see that most of the startups, they are asking about funding. I'm not a startup, so I'm usually not very interested about funding in a post-COVID. But something you were speaking recently about that banks are trustworthy institution, which I agree with you. They are trustworthy institution. But for example, we had a discussion here in our lab at the university, and we were thinking that maybe we are moving in Norway, or not in Norway, but within this fintech world, into like banks. There will be institutions where we can put only to save money. For example, to make payments, I always make VIPs. VIPs is a fintech. Even if it is owned by banks, it is a fintech. For my insurance, it is online. I have no idea who is my insurance. Maybe it is for sure it is a fintech. So normally when I'm asking for a loan, I don't mind taking a loan from a fintech, as far as they are the one who are going to take the risk by giving me the money. So, but however, to keep my money, I will always keep it in a bank. I will never trust a fintech and give them my money, because I know that there is no guarantee if they go bankrupt one day or another, they are not going to give me my money. So do you think that banks, they are moving into, if they don't participate into this digital transformation, there will be a place where only for money, and maybe all other services, they will be handled by fintech? I don't know. What do you think?
So you're right that payments in particular, whether it's where you mentioned VIPs, every Nordic country has their own version of P2P payments. In the US, obviously you've had Venmo, and now you've had Zelle. The banks have done P2P payments recently, and even longer. You could go back and look over the last 20 years, and you could look at credit cards, which in the so-called Western world is the dominant payment rail. Credit cards used to be a bank. Credit cards were actually, I was going to say credit cards were built by banks. Yeah, credit cards are built by banks. Diners Club would claim to be one of the first credit card companies in the world, and Amex was an important part of that as well. But generally, as credit cards grew in the 1960s, 1970s in the US, it was different banking groups or federations that built credit cards. One became Visa, the other one became MasterCard. And in the last 10, 20 years, banks is, credit cards are still very important for banks, but the payment rails, the card payment rails, merchant acquiring as a business has largely gone outside the banking industry. They've become part of specialist companies, which are either listed in the stock market as independent companies, or they're owned by private equity. And I'm sure the banks could go back 20 years. If you could fly back in time in the kind of, time travel machine to the year 1999 or 2000, and you have the knowledge that you have today, and you said, "Listen, this is how big these card companies become in value and earnings. Do you still want to sell those businesses?" So banks have seen the dangers and the risks of basically almost ceding, giving up, voluntarily or involuntarily, large parts of the consumer payment business. And they've seen what's happened. Now, in Europe, this is not so much true of Norway, but in Europe outside Scandinavia, the challenge banks have had, and this includes the UK, is that their profitability has been so weak in the last 10 years or 12 years because of low interest rates, because of lack of growth in the economies in continental Europe and the UK, their profitability has been so weak that in order to support their balance sheet, they've often sold businesses that now you look back and say, they really shouldn't have sold those businesses because of the value those businesses had. So in a way, banks have given up lots of businesses that they should own. This is on the consumer side. In the capital market side, it's different. In the wholesale side, but this is not a, we often think that this trend has just happened now. With, you mentioned VIPs, or this trend has been going on for a long time. So you can go back to money market accounts. But you said you want to keep your saving with a bank, but money market accounts, when they were introduced in the US, I think it was like 40 years ago. 40 years ago, money market accounts were a direct challenge to the bank's savings role in the US. And basically brokerage firms offered money market accounts because the US is more of a market-based rather than a bank balance sheet-based credit system. And that was a direct challenge to the bank's savings capacity. So sometimes, I guess what the point I'm trying to make is we sort of look at what's happening now in the last 1, 2, 3 years and think everything is like a big transformation and new. It's sure that when it comes to use of technology and digital, we're in a different ballgame, but a lot of the product challenges for banks have been going on for 40, 50 years now. And so it's not new. Banks are having to share. What's new is that it's definitely not new in the US. In the US, you had what the Americans call their checking account at a bank, but you might have your savings with a stockbroker, not a bank. Your insurance will be with an insurance company. Your card may or may not be with a bank. So the US banking system or financial system has been very fragmented for a good 40, 50 years now. As China has developed in the last 10, 20 years, China has become similarly fragmented. In a way, Scandinavia, Norway, Europe, or parts of continental Europe were the exception in that the bank did multiple products. That you go to the bank and you'd have your savings account there, you'd get your mortgage from the bank, you do your payments with that was quite kind of unusual compared to the US. And also it's kind of a today phenomenon. If you go back right when I started my career at Citi in the late 97, mortgages were just beginning. Mortgages used to be done by specialist mortgage institutions that weren't part of banks. They were separate. They only became part of banks during the 1990s in many cases. So we just assume now a bank does a mortgage. If you were living in the 1980s, the bank in the UK or in Sweden, the two markets I probably know best, wouldn't have given you the mortgage. You'd have gone to a specialist company. So what you described today is a very long-term trend. There's no reason you have to use a bank beyond that safekeeping perspective you talked about. That I trust the bank won't go bust, so I'll keep my savings in the bank, and I trust it because of regulation. But very few people love their bank. They trust their bank, right? I'm sure they love our bank, but very few people, and that's the gap for fintechs or for big techs or for a new entrant, is that these traditional institutions are trusted because of regulation, but they don't necessarily delight their clients or create a sense of affection or love, and that gap, that's the market opportunity in the B2C space for new entrants.
Thank you. Very interesting.
Thank you.
We have 10 more minutes, so we can either take one more question, and this is the opportunity to ask your question directly. You can ask anything. You can post it on the chat as well, and if not, we can maybe just close with some final advice from you, Ronit, for the startups on one side and the corporates, given these times.
Sure. If there are no final questions, first of all, thank you for having me on this session. If you need to contact me or reach out to me, you can do that directly or via, you can go on LinkedIn or on Twitter, and you can reach out to me. or you can email me directly if you want. In terms of final advice or comments, so I've been following the financial services industry now for about 25 years, since the mid 1990s, and what's for me been super interesting has been that in every period you have change. So back in the mid 1990s, I mentioned how mortgages didn't get done by banks. Mortgages got done by special institutions that then got bought by banks. A lot of building in the UK, they were called building societies. Building societies listed in the stock market. Building societies got bought by banks. And 25 years later, most mortgages in the UK are provided by banks, not building societies. But that was a change that happened really in the sort of during the 1990s. Roll forward to the early 2000s, and I remember visiting Stockholm and also Oslo and Copenhagen, but sitting in Sweden talking about how the internet was going to change everything. It was like 99, 2000. And everyone was talking about internet banking. And that was the first wave. Nothing really happened in terms of, there was a brief flurry of capital that came into the industry and it disappeared. But roll forward to the last few years, there are some fundamental changes that are taking place in terms of how technology interacts with financial services, and all of you on this webinar are very familiar with that. So I need to spell it out, and that makes now a super interesting time from the perspective of how financial services are being reshaped, how the sort of the building blocks are being put together or pulled apart. You know, every now and then. I think for me in the US and Western Europe, 1950s, 1960s, there was a huge amount of change. All the form factors that we live in, or we live with, so institutional capital markets, like, you know, an institutional equity market, institutional asset management, sort of emerged in the 1960s. Credit cards start in 1950, but really become big as the middle class grows in the US. And so we live with many of these form factors for 40, 50, 60 years. Then there were changes in between, like the growth of securitization in the 1980s and 1990s, the growth of derivatives. But we're in this another amazing period of change. It seems to happen every 20, 30 years. And that creates huge opportunities for fintechs. Either as, for now, for the short term, I think B2B is the hot space to be. But if you have funding and you're funded through this year, you can see yourself out to next year, there's going to be also very interesting opportunities in B2C. So thanks for having me on. Love to carry on the conversation with you guys. If you want to reach out to me individually, ping me, or go via your friends in Oslo, and I'm sure they'll connect us.
Yes, we are. I have Anneli as my main contact. So each time that there is a startup, like last time, one of the startups wanted to get in touch with Citi, I just get some info from Anneli and forward the contact details, and yes, make the intro. Thank you so much. Maybe Anneli, you want to say a few words about your accelerator? You are muted. And maybe you can say what we do for the startups at Citi.
Yeah, so I sent some information to Raja as well, so you can ask her to send some brief information. We had Ronit on last week on Ask Me Anything. So she's our head of external innovation and venture investments Israel. We have an accelerator program which is global, and it's good because we're working with the Nordics. She's hands-on, screening, identifying good, interesting startups that are growing and next phase, and also, you know, could meet the criteria of the accelerator program. This is happening, you know, continuously, just to find things that makes a difference. And the good part about that is that everything is virtual nowadays. If you match the criteria, Citi do actually have this kind of a pilot with the Nordic region to do screen here and have access through these hubs in the Nordics, like TheFactory, for your members in your network. So when you meet the criteria, it's a virtual program, and before you can of course travel as well, but right now we can't. But there's a global jury that you pitch for if you meet criteria, and And also then there is actually matchmaking with a mentor and the user case, which means that we don't just say we do something and nothing happens. It is a very tough screening, so it's not very many who go through it, but when you do actually mean you get a mentor from the industry and Citi, you do get a use case, you do get to the next step, which means that, you know, they take your hands, there's no stake, equity taken or anything, it's pro bono. So it's actually to give all our own global stakeholders, partners, companies, we combine this with Visa or MasterCard, other companies who want to do things. So looking for solutions within some specific areas within FinTech. That's a very quick description, but means that the global local connection growing can go fast. And that's why we are, you know, here to work with the factory and you guys for those opportunities.
Yes,
with,
so
with the team here. And the team here is, of course, expanding through different kind of parts of the businesses to help you on the progress as well.
So if you are a FinTech listening to us and you think that your solution could be interesting for Citi, you get in touch with me and I will connect you to Amelie. Thank you, everyone. Thank you for staying with us till the end, and thank you for all the questions. And this is it for today. Thank you and have a great day.
Thank you
Bye.
so much.
Bye.
Bye.
Bye.